The signs are clear. The biggest wave of job losses since the financial crisis is about to hit. I'm your host, Steve Metre, and thanks for joining me today. In our show today, what's happening behind the scenes in the labor market will outright shock you. I'm going to show you why after the first of the year, things for U.S. workers is going to get far worse, and which sectors are going to be the first to go. Plus, we have a sponsor for today's show. I'd like to welcome Thermabright back to the show. You can find them on the TSXV under symbol THRM and on the OTCQB under symbol TBRIF. And we first featured them back at the end of July. Their stock went off to rally 150%. Thermabright is a developer and investment partner specializing in advanced diagnostic and medical device technologies. And when you see the charts up, we're right back at the same point we were in July, setting up what we think could be a massive move in their stock. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where we picked today's story up with a headline: as U.S. industrial production unexpectedly drops on mining and utilities. And yesterday we talked about how in New York, the manufacturing sector reversed all of its gains since the election. And now we're seeing all across the country that U.S. industrial production and manufacturing is plunging. And this is threatening to put millions of Americans on the unemployment line starting the beginning of the year. The 0.1% decrease in production at factories, mines, and utilities followed a downwardly revised 0.4% drop a month earlier. Manufacturing output rose a disappointing 0.2% after a downwardly revised 0.7% slide a month earlier. And one of the challenges we're facing right now is the data is being downwardly revised month after month. We see this in the payrolls. Now, last month we saw an upward revision, but in general, we continue to see all this data points downwardly revised. So as investors and consumers look to the data to see what the health of the U.S. economy is, well, what we're finding out is far worse than what the headline data suggests. And this is a huge problem because behind the scenes, as you're about to see, manufacturers are in danger. And that means when things go wrong for them, hours get cut and then jobs go. And here we can see industrial production as we take a look at the NASDAQ 100 on a year-over-year rate of change. And investors are betting big on an outcome that the economy is not pricing in. Now you look at this chart and say, well, it looks like the equity market is right in line with where it should be, except on the right, it's showing the NASDAQ running a 30% year-on-year rate of change, whereas industrial production, well, it's less than zero. And that's one of the problems here, is that investors are betting on this outcome and the economy is not responding. In fact, it's starting to head the other way. And what this means for millions of Americans is the worst case scenario is about to hit. The Fed's current report showed capacity utilization at factories, a measure of potential output being used, was little change at 76%. The overall industrial utilization rate decreased to 76.8%, the lowest since April of 2021. And the problem with this data here is when you look at capacity utilization, again, it tells you what percent of a factory is being utilized. So as the capacity of a factory declines, well, there's one input cost that you can get rid of, and it's easy to do. You cut the hours of your workforce, you start slashing jobs, because if you don't have work for them, well, next thing you know, they're standing around doing nothing or cleaning the shop. And at some point, you can only sweep the floor so many times before you have to send workers to the unemployment line, which is why in the beginning of the year, we're likely to see employers all across the country, particularly starting in the manufacturing sector, are about to hit a major wave of layoffs. And something we think is going to surge higher, that is the stock for our sponsor for today's show, Thermabright. You can find them on the TSXV under symbol THRM and on the OTCQB under symbol TBRIF. And back here at the end of August, on the 31st, we featured them on the show. Is opened the next day at 2 cents a share and went on to rally 150% up to 7 cents. And right now it's sitting right under 2 cents a share. And this is the point where we see buyers are stepping in here in a big way. Wait till you see the chart at the end of the show. What we see is it's setting up another big move upwards of 5 cents a share. Again, stay tuned to the end of the show or check out the pinned comment or description for more information, because when we look at the link between capacity utilization and the unemployment rate with the labor market, it's very clear why at the first of the year we're going to see a lot of jobs lost. And what we're seeing in New York alone, based on their recent data, is just an indication of what's going to happen all over the world. We noted that right after the election, there was a huge surge in new orders, but because there wasn't demand from consumers, consumers. The following month, everything went down, telling us that somewhere amongst the first quarter of next year, companies are going to be forced to do what they don't want to do, and that's get rid of workers. And you can see the near mirror relationship between the two data series. As capacity utilization drops and less of a factory's output is being used, well, workers hit the unemployment line. The problem is they don't have any other opportunity to find work, because what typically happens is manufacturers all across the country start to lay off. And we can see this relationship over and over throughout every cycle. And now, as we find out that capacity utilization is continuing to decline, what it suggests is, unlike what the Fed believes, what we hear from Fed Chair Powell, that the peak of the unemployment rate is in. No, what it means is we're about to break out to the upside. It further is validating what we're seeing in continued unemployment claims. Everyone's been saying that this is going to head lower, but when we overlay continued claims against capacity utilization, what it's telling us that those who are on unemployment, and what we're finding out, more American workers are getting stuck there for 3 months or more with no sign of being able to find work. What this is indicating, based on what the data from the factory is suggesting, that more workers are going to hit the unemployment line and get stuck there, thus validating the data we're seeing. And the bond market is also giving us a clear signal of what is to come. While many people think a soft landing is the narrative, what we see here very clearly, when we look at 6-month bill yields against industrial production, that's shown in blue on a year-over-year rate of change, what we can see is interest rates on the front end of the curve go down. It means industrial production likely to head lower. You can see in every instant that's exactly what it's indicating. Right now we see bill yields rolling over to the downside. What it's indicating is an industrial production about to collapse. When that happens, Americans will hit the unemployment line. They'll have no other opportunity to get back into the labor market, because manufacturers all across the country will be laying off. But many are hoping that that can't be the case, because today we found out that retail sales surged, but it's really the truth of what's behind the numbers that will shock you. As U.S. retail sales strengthen on jump in motor vehicle purchases, as consumers went out and bought vehicles in a big way. Not adjusted for inflation, retail sales increased 0.7% after upward revisions to the prior 2 months, suggesting that consumers are looking to spend and spend big. Excluding autos, though, sales climbed a more modest 0.2% for the second month, barely keeping up with inflation, if at all. And that's one of the problems here. We're seeing retail sales rise in nominal terms, but inflation-adjusted terms, the data is not that strong, suggesting consumers are paying more for goods, but they're not getting as much for their money. That's the problem with this data series, as e-commerce sales jumped 1.8% as Black Friday and Cyber Monday promotions generated massive sales on platforms like Amazon and TikTok Shop. Receipts at building material stores rose 0.4%. Spending at bars and restaurants, meanwhile, the only service sector category in the retail report, fell for the first time since March. Grocery store sales also declined as consumers cut back on their spending. But what's really interesting here, when you see that consumers are feeling really good about the economy, and we see that in some of the data. The survey data says that consumers are extremely optimistic, but when their wallets are indicating they're optimistic as well, the first thing they do is go out and eat. So when we see that consumers are cutting back on restaurants and bars, that is a massive red flag for the economy. But something else we're seeing here, and something else even I personally experiencing, is that people are worried about the tariffs. So what they're doing is they're going out and buying things they don't need quite yet, but they will need in the future, consumable goods, and putting them on the shelf. I know I'm guilty. I'm doing the same exact thing, taking advantage of deals right now, and that's driving retail sales. But what's coming next year for retail sales is going to shock you. But let's take a look at this next chart first, because while there's all this excitement that in nominal terms retail sales are rising, let's take a look at real retail sales. This is adjusted for inflation. What do we see? For the third time in the last 3 years, we see real retail sales just perked above the positive line just for a moment. I believe that's going to turn down and make the case for why. as the data suggests consumers remained resilient during the crucial holiday shopping season, lured by discounts and bolstered by incomes that have been rising faster than prices. But that's always the story. Remember, I told you the media would fixate on this, that incomes are rising faster than prices, that U.S. consumers are in a great financial position. They were just waiting for the election to end, and then they're going to go out and spend. But the truth is, when you look at the big picture, incomes are not rising that much faster than inflation, because we're seeing workers hit the unemployment line, and at the same time, their hours worked are getting cut. When you combine those factors, not to mention that U.S. workers have been behind the curve of inflation due to the pandemic, they're still underwater here, not in great shape. They're taking advantage of deals before, of course, we know the tariffs that may come next year. Measures of confidence have also been climbing since November election. Some consumers have reported they could avoid higher prices. Here you see it from possible new tariffs imposed by the Trump administration by purchasing big ticket items now. And this is a huge risk for the economy, because when you pull forward demand, well, something happens, and that means demand in the future can collapse unless the economy turns around. Wait till you see, I got a great chart. It's going to blow you away. But let's take a look at this one first. Let's look at the issue here. And this is what the experts are saying is, look, average hourly earnings of production and non-supervisory employees, this shown in red on a year-over-year rate of change, is outpacing inflation. But what they don't realize is this period from about 2021 all the way into 2023, where inflation was much higher than wages, really hurt American households. Even though wages are higher, more Americans are hitting the unemployment line, meaning their wage is actually lower. So just from a data series point, you see the media, you'll see experts fixating on this, but it's not telling us the true story, because if it was the case that Americans were getting ahead, then real retail sales wouldn't be negative except for 3 times over the last 3 years. That wouldn't be the case at all. And yet we see the media fixate on things like consumer confidence, that consumers are optimistic, but there's no relationship between the two, because it has everything to do with finances. I can be optimistic about the future, but have no money today, and the no money today means I don't spend today. It just means I'm hopeful things are going to get better. We could see when we look at the University of Michigan Consumer Sentiment Survey in red against real retail sales in blue, what do we see? Rising confidence here in the early to mid 90s. And what happened? Retail sales went down. You see the same effect right around 1999. Confidence was up. Of course, the market was up, and real retail sales went down and into contraction before confidence turned direction. See the same thing around 2006, once again in 2014, and now you see it again. The question is, why has real retail sales been negative for nearly 3 years running while confidence has been rising? It's because, for one simple reason, confidence does not transmit into spending. But one of the risks here of the threat of tariffs is pulling demand forward from next year into this year. And check out this chart from Bank of America, and they note that the robust spending that we saw turn around from Thanksgiving continued through Cyber Monday. But look at the risk here is when you see what happens to spending after the holiday season, it plunges. And what that's telling us is that new order books from manufacturers are going to further plunge, backlogs are going to get worked through, and people in the manufacturing sector are going to be the first to lose their jobs. That's going to be followed by those in the retail space as they watch consumer foot traffic outright plunge. And we can see evidence that the bond market is pricing that in as we come back to 6-month bill yields against real retail sales. What do we see? Bill yields coming down here around 2000, and what happens? Retail sales go down. So the notion that lower interest rates is going to drive consumption, it's not what the bond market is telling us. You see that happen again around 2007, going into the pandemic. And how about now? Everyone's saying how we need a little bit lower interest rates. Well, interest rates are coming down, except the problem is it's telling us financial conditions are tightening. But when we look at capacity utilization and we look at labor market trends, it's telling us that exactly what's coming for the U.S. economy is slowing down, and that millions of Americans, starting with manufacturers, then getting into retail and spreading all across the services sector, they're going to hit the unemployment line and get stuck there. But meanwhile, builders remain highly optimistic as we now turn to U.S. home builder outlook that jumps on optimism that Trump will cut the red tape. But will that be enough to turn the housing market around? A gauge of sales in the next 6 months increased to 66 this month, the highest since April 2022, based on indices from the National Association of Home Builders and Wells Fargo. The overall confidence index and a measure of present sales were both unchanged compared with November. But get this, foot traffic from prospective buyers dipped slightly. So despite the fact we've seen a little bit lower interest rates and optimism surging, as we see from the University of Michigan Consumer Confidence Survey, what we're seeing from consumers, they cannot afford these higher prices of homes. They cannot afford the payment at these higher rates. But meanwhile, the industry analysts anticipate the outlook will be challenging, putting a counterpoint to the builders. With the Federal Reserve now expected to make fewer interest rate cuts next year, mortgage rates will likely stay higher for longer. Well, that's not exactly what the bond market is suggesting here. In fact, what's telling us the exact opposite is likely to happen. As we turn back now to the 6-month bill yields shown in red against 30-year fixed mortgage rates, that's in blue. What we can see is when financial conditions tighten and short-term interest rates fall, eventually that impacts long-term rates. And here you can see 30-year fixed rate mortgages do see interest rates decline. The problem is, you'll notice when they're both happening, there's a gray shaded bar showed up, and that means we're headed squarely into recession. And for home builders, we're sitting on a massive amount of inventory. Well, that's not good news. We've seen what happens in the past. They eventually have fire sales that drives housing prices down, and it could be just another nail in the U.S. economy that we're already going to see unwind, as manufacturing jobs and retail jobs are going to be the first to go starting next year. But one company we think is going to be a bright spot in the coming year, that is the stock for our sponsor of today's show, Thermobright. You can find them on the TSXV under symbol THRM and on the OTCQB under symbol TBRIF. Wait till you see these charts. Stay tuned, because their product, the big one, is VenoWave, and it's an FDA cleared circulation booster designed to improve circulation in lower extremities. The VenoWave is a medical compression pump that is lightweight, compact, battery operated, and designed to treat and alleviate the symptoms associated with poor circulation. When worn firmly on the calf, the VenoWave produces a waveform motion, forcing blood from the feet and legs back to the heart. This increase in blood flow draws oxygen to wound and ulcer sites, prevents blood pooling and clotting, and alleviates symptoms of post-traumatic syndrome and other chronic venous insufficiencies. And this, I believe, is going to be a huge benefit for the market. This is something that we're going to see is going to drive Thermobright stock up. You saw the chart before. We're going to look at it again, because I think it's setting up another monster move here. And the risk factors associated with deep vein thrombocytosis include surgery, obesity, smoking, prolonged sitting, air flights over 4 hours, pregnancy, hospitalization, cancer patient, leg injury, and certain medications, suggesting that VenoWave has a huge market for it. And we're going to see consumers driving demand for this in a big way. And that's going to drive, of course, revenues, profits, and Thermobright stock price. Again, on the TSXV under symbol THRM and on the OTCQB under symbol TBRIF. Let's take a look at some of the recent headlines as their distribution partners achieve 100% HCPS CS code reimbursement in under 60 days. And that means they have successfully secured Medicare and Medicaid level 2 code reimbursements within a 60-day time frame. And since October 1st, more than 110 VenoWave VW5 units have been deployed to patients across the U.S. in various pilot tests. Today, 25 of these units have received full reimbursement through either commercial health network payers or Medicare and Medicaid. The company's distribution partners anticipate further reimbursement success for the remaining 85 pilot test units in the short term. And based on the current results, the company has begun discussions around VenoWave sales roadmap, delivery, and manufacturing schedules with its distributors. And the VenoWave VW5, which qualifies for Medicare and Medicaid code reimbursement under 10 medical indications, is built for durability and supports repeated use across multiple patients. And Thermobright secures nationwide U.S. distribution partner for VenoWave. Now we're going back to August 23rd with strong distribution interest. Thermobright expects its current inventory of 2,000 units, representing up to $2.38 million in reimbursement value, to be quickly sold, as they now have the addition of a new nationwide U.S. durable medical equipment distribution partner. The device, effective for 10 circulatory indications, offers up to $1,199 reimbursement, which will significantly contribute to the company's revenue and pave the way for sustained growth and enhanced marketplace valuation. And ThermBright announces Quantify Medical as a nationwide U.S. distribution partner. Following the conclusion of the test, Quantify Medical looks to acquire the remaining Venaway VW5 inventory. If all inventory were to be purchased by the distributor, it would represent up to $2.3 million in U.S. dollars reimbursement. In August of 2024, the Venaway VW5 was the first device of its kind to receive permanent Medicare and Medicaid Level 2 code, which qualifies for reimbursement for 10 indications. Let's talk about some indicators when it comes to their stock price, because back on August 31st, we first featured ThermBright on our show. The stock opened at 2 cents the following day and took off like a rocket, generating 150% return following. And right now, we see it coming right back into a zone of support where buyers are stepping underneath here. We said before, back in August, you want to look to buy ThermBright, which is in that 1 to 2 cent range. It's back here, and you can see it quickly moves through supply zones as it shot up and pulled back, meaning its next upward move could be around 5 cents a share. And we can zoom into the 30-day chart, and what do we see very clearly? That its price got down into 2 cent a share zone. What happened is buyers have stepped in here, putting a potential floor on the stock, which could be the catalyst for massive returns for ThermBright. Again, you can find them on the TSXV under symbol THRIM, and on the OTCQB under symbol TBRIF. And as always, with any company we feature on our show, you're under no obligation to purchase a stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.